Okay, we are back with our live coverage here at the CAIS conference at the Beverly Hilton, and we are obviously talking about alts all day today, all day tomorrow. And my next guest is Ted Koenig, who is the CEO of Monroe. Ted, thanks for joining us.
My pleasure, good to see you.
All right, so the question that's top of my mind, which I think is the question that's top of a lot of people's mind, is private credit getting to be a crowded trade, a little long in the tooth? What do you think?
You know, it's interesting. Private credit is, I've been in this business 25 years. I've had the same business card for 25 years, which not a lot of people can say.
No.
I've always done private credit. Before it was private credit, we did private credit. Today, the asset class has continued to grow because institutional investors need it. If you're a pension fund, you need it to cover your obligations. Health, welfare, education, retirement. If you're an institution, you need it to cover insurance policies that are written for 50, 60 years.
Yeah.
High net worth retail channel has just found this product about 5, 6 years ago for the same reasons. Generates current income, consistent current income. Every year, every quarter we pay. A lot of money has come into it, but what's happened is the banks have withdrawn from the lending markets, particularly the buyout lending market. So all that's happened is private credit has taken the place of what the banks used to do in this market.
Right, absolutely. So now, not all private credit is created equally, and there's different types of private credit. Could you maybe give us just a very high-level overview of the different types of private credit and perhaps where maybe the sweet spot might be and how Monroe addresses that?
Yeah, it depends what you're looking for.
Yeah.
Credit, think 3 basic areas. Number 1, syndicated credit, liquid credit.
Yeah.
Those are ETFs. That's what you buy with Nuveen or BlackRock or someone like that, and you're just taking market exposure. It's a beta investment. When your advisors tell you put money in bonds and stocks, that's what happens. You get into these beta exposure to credit. Tradable liquid, that's one area. Low returns, high leverage, and it's complete market risk, macro market risk. Second area is upper middle market private credit. Think about Apollo, Ares, Carlyle, KKR, Churchill, Gollum. Great firms, but they focus on the upper middle market.
Right.
It's a crowded place. It competes with the liquid market. Leverage ratios are very high, and pricing is very competitive with the traded market. The third area, and that's the area we play in, Monroe, is the lower middle market. $40 million EBITDA size companies and below.
Right.
That's lower middle market private credit. We're the largest by far in that space in the US, and that's what we've done for 25 years. And that's an area where there's more pricing capacity for us, lower leverage, and there's covenants in all of the deals. There's covenants, which are rare in the other areas of private credit.
Right, so is it fair to say then at this lower middle market where you guys invest in, that you have, for lack of a better term, more leverage because they are smaller, and with that leverage you're insisting on more stringent covenants. Is that a fair statement?
Covenants, yes, but also better pricing and better leverage.
Right.
So it's a better risk return. Now, the downside is the market is not infinite like those other areas. Our market is limited. So you've got to source the deals, you've got to be in that market, and it's relationship driven. So the players that focus on that market have a huge advantage because we can access that market. It's only an average size deal is about 100, 120 million. So if you're a big player, you just can't put enough money in that market to make it worth your while. So we've managed to keep all the other guys out of it and really grow our business in that space.
Interesting. Okay, so it makes sense for some of these other players that are in those larger markets. It just doesn't move the needle for them to write a $100 million check.
Now, if you're managing $1 trillion or 6, 7, 800 billion,
right,
you can't invest at $75, $100 million levels. Right. You've got to invest in much multiples of that in order to move the needle for yourself. That's why we've had this market pretty much to ourselves, and we've been able to grow in it.
Okay, so now, to your point earlier, we are seeing a lot of interest, a lot more interest from the retail players, ourselves included. So at My Shop Sovereign, we launched the Align Alternative Access Fund. Full disclosure, you guys are one of the funds in there. We're happy to have you, and I think it's a nice diverse fund. Absolutely. Where do you see us 3, 5 years down the road? So if the floodgates really are opening up, more retail investors are coming in, what does that mean? What's the second derivative of that?
You know, it's interesting. That's a great question. Everyone's asking me that. I did a Bloomberg TV thing last week,
Yeah.
same question.
Yeah.
So here's the challenge. As more money comes into the space, all that money is going to come in through the wealth channel, and that money needs to get invested immediately. Because as wealth money comes in, it's not a drawdown fund.
Right.
It comes in and it's got to be invested. If it doesn't get invested, it's not earning, so you're drawing your IRRs down for your funds, and funds can't have that.
Right.
So all that money is going to get dumped into that upper end of that market, the liquid part of that market, which is going to create a tsunami effect. Higher leverage, lower pricing. A lot of deals are going to get done that probably shouldn't get done because the money's coming in so fast, and that's going to be a challenge. That's one of the things that as an asset manager, I'm probably swimming against the current on this, but I'm not a huge fan of all this 401k money coming in. It's going to be great for asset managers, yes, more AUMs, more fees,
Yeah.
more profits, but it's not going to be great from the investor side, because what's going to happen is that funds are going to prepare vehicles that are going to be high net worth retail only. Institutional investors are not going to go into those vehicles, and I'm concerned that those vehicles are going to get subpar investments and subpar performance just because of the sheer amount of capital that's coming in.
Yeah.
The rule I have at Monroe is we will never put high net worth wealth investors into an investment unless it's side by side with other institutional investors. So we invest institutional capital and our wealth capital together. Otherwise, I think it's a high risk.
I tell you what, that's one of the main reasons why we wanted to have you guys in our fund. And we're going to talk about this more a little later on today, the different ways of getting exposure. And I think you'll probably agree with this. You know, we're starting to see alternatives in ETFs. I personally think that's a mistake. What do you think about that?
Yeah, it's a challenge. I mean,
He's being more diplomatic than I am.
The question is, and again, I can't repeat this enough, is private assets need to be invested through some sophisticated investors so they understand what they're getting into.
Right.
My average leverage attachment point on my credits across 520 companies is 4 turns of leverage. That's private credit in the lower middle market.
Yeah.
The same portfolio at an upper middle market lender, asset manager, attaches at 7 times leverage. So if you're an investor, you may not know that I'm at 4 turns of leverage at 40% loan to value. Another manager's at 7 turns of leverage at 70% of value. That's a huge differential in the risk parameter of your portfolio.
Absolutely.
And without knowledge and information, it's very hard. As all this money streams into this channel, there is no way that the average investor is going to know the differences between upper middle market, lower middle market, leverage ratios, attachment points, and pricing, frankly.
Yeah.
You know, we price in our market about 100 basis points wider of the pricing in the upper end of the market.
Right.
So from a risk return standpoint, again, it's superior, but the market's not as big. So you have to have managers that can access that market.
Yeah, I think that's really important, and I do believe that as these floodgates get opened even wider, and I think it's just inevitable, they will make their way into the 401ks. I don't have a problem with that necessarily, but I think the structure of those investments are critical, and how the investor, the end investor, gets their hands on it. There needs to be guardrails with either an advisor or some other vehicle to make sure they're not getting themselves in over their heads. Yeah,
Yeah, that should be a rule. I mean, I'm telling you, I think probably a good, my guardrail is you have to invest institutional capital alongside the retail capital.
Yes.
And that's not going to happen because there's so much money coming in. Some of these big asset managers, it's going to be a fee boom for them. And
Yes.
they're going to push as much money as they can into that space.
Right. I think that's important to keep in mind. Okay, so as we're coming up on time here, and we're talking to advisors on this channel, of course, what advice would you give to them if there's an advisor out there that's starting to dip their toe in the water of the alt space? What would you say to them?
Get educated.
Yeah.
Ask questions. Ask questions. You know, this is all common sense. Pricing is going to be better where there's less competition. Leverage is going to be much higher where there's a more competitive market, where more money's chasing. Credit is different than equity. Credit, you want stability. You don't want your companies to grow at a straight line up. You want just consistency of earnings. Private equity requires growth. they're going to push the envelope of risk to drive that growth. Credit's a different animal. Credit, you want to sleep at night. My view and what we do is we get paid so people can sleep at night and stay wealthy. We're not trying to get people wealthy. We want people to stay wealthy.
All right. I tell you what, Ted, that's a great place to put a pin in it for today, so thank you for that.
My pleasure.
All
nice
right.
to see you. Thank you.
Likewise, Ted. Good to see you again. Okay, so that's a great place to put it in for this particular segment. We've got 2 more segments later today, including how to get yourself exposed to these alternatives, so stay tuned for that. I'll be back in another 45 to 50 minutes with that content for you. Thanks for joining us, and Ted, thanks again.
Thank you.